So what is that risky behavior? In large part involves Wall Street bank trading in over-the-counter derivatives. These financial instruments contain many of the toxic mortgage-backed securities that nearly brought down our financial system in 2008. Nothing has been done as of this writing to change this market, and in fact, the derivatives trading has increased dramatically since 2008. According to the Comptroller of the Currency Administrator of National Banks, the notional value of derivatives held by U.S. commercial banks in the third quarter of 2008 was $175.8 trillion. By the second quarter of 2009, that had increased to $203.5 trillion, and by the fourth quarter of 2009, it was $212.8 trillion. Worldwide, over-the-counter derivatives have grown to become the largest global market in the last decade, both in terms of size and the interconnectedness of institutions. Between June of 2001 and June of 2008, the over-the-counter derivatives market increased by 535%, with a notional value of $680 trillion. Just to put that in perspective, the GDP of the entire planet in 2008 was $70.5 trillion. There is nearly 10 times the amount of these toxic assets in circulation as there is money on the planet. Our nation's 5 largest commercial banks represent over 90% of that industry. So why is this so dangerous? Well, for one reason, Congress eliminated the Glass-Steagall Act in 1999, removing the legal separation of commercial banks and investment banks that had protected citizens' deposits since the Great Depression. With that, investment banks can now legally dip into the customer deposits of their commercial counterparts and use those funds to gamble on derivatives, knowing that the FDIC will insure them with the full faith and credit of the U.S. government for up to $250,000 per person if they lose. The FDIC is now responsible for some $4.8 trillion in U.S. deposits. However, the total U.S. government revenue predicted for all of 2008 or 2010 is something just shy of $4.6 trillion. So how much does the FDIC have on hand to insure all our deposits? For 2009, according to their own records, it was $13 billion, down from $52.4 billion in 2007. The safety of the U.S. banking system is like an onion. The more you peel back the layers, the worse it smells. For this and several other reasons, one way Americans can protect their assets from Wall Street banks that are using them to enrich themselves at the cost of average citizens is to consider moving your assets north. Now here I'd like to explain what Simon Johnson was saying in terms of comparing the Canadian banking system with the American banking system. We are not comparing apples to apples here because the regulations are completely different, and I will explain that. But it is important to know this. According to the World Economic Forum, the Canadian banking system is the safest in the world. The U.S. banking system, by contrast, ranks 40th. According to the FDIC, 223 U.S. banks have failed since the start of the Great Recession, with another 702 defined as problem banks by Chairwoman Sheila Bair. Canada, by contrast, is the only industrialized nation that has not experienced a single bank failure during the current recession. It has had only 2 bank failures in its entire history, compared with 12,000 bank failures in the United States since the Great Depression, 3,000 during the S&L crisis alone. Why is the Canadian banking system so much safer than the U.S. banking system? Well, for one thing, Canadian banks keep and service nearly 70% of their mortgage loans versus selling these loans as is typical in the U.S. This encourages prudent lending practices in Canada since banks are putting their own capital at risk. In the U.S., banks typically sell mortgage loans as bundled securities, so there is more focus on making as many loans as possible, regardless of a homeowner's ability to pay. Wall Street banks lack the incentive of Canadian banks to make sure that they loan to homeowners who can pay them back, since they're not risking any of their own capital to make them. This explains why the delinquency rate for home mortgages in the U.S. was nearly 9.5% in 2009 and only 0.545% in Canada, half a percentage point. Canadian banks also have higher capital rates than U.S. banks and a much smaller debt-to-cash ratio. U.S. Bancorp in 2009, for example, had a debt-to-cash ratio of 1,059%. PNC Financial, 650%, Wells Fargo 293, and Bank of America 223%. This contrasts with a debt-to-cash ratio of 23% for the Royal Bank of Canada, 39% for the Bank of Nova Scotia, and 16% for the Toronto Dominion Bank. Canadian banks also limit their leverages to no more than 18 to 1 by law, while U.S. banks are typically leveraged well over 25 to 1. However, the biggest difference in the safety of the Canadian banks versus Wall Street banks is their use and exposure to derivatives, those toxic assets that nearly brought down our financial system in 2008. As mentioned above, the top 5 U.S. banks control this market, which provides nothing of value to the larger society but risk. Unlike Canadian banks, the largest U.S. banks no longer primarily take our deposits and loan them to expand businesses, invest in infrastructure projects, build homes, create jobs, as was typical of the banking sector for most of our history. Now, to a great extent, they take our deposits and gamble with them on high-risk Wall Street trades that do nothing but make huge profits at great risks for the banks. These risks are covered with taxpayer funds if they lose, but provide Wall Street banks huge profits if they win. In the U.S., Wall Street banks can legally gamble with the assets of average Americans, our pensions, college funds, retirement accounts, and savings. And with those huge profits made largely from derivative trading, big banks are able to pay off lawmakers and control regulators so they can continue gambling with our assets. Wall Street knows that Congress will bail them out using taxpayer money because they are holding our assets hostage. The only way to change this dynamic is to break up the big banks so they have less power or control over our political and financial systems. And one way to do that is to remove and protect our assets from use by Wall Street banks. We can help shrink Wall Street banks by using cash instead of credit, by moving our assets out of the larger banks. In addition, if we want to protect our financial assets from being held hostage by the risky behavior of Wall Street, we might consider moving some of our assets out of the U.S. financial system altogether. This is not an easy issue to decide by any means. Damage will be done regardless of what we choose. If we do nothing, then many wise economists such as Simon Johnson predict we are in for another large economic collapse and taxpayer bailout from Wall Street. You cannot imagine a good scenario with the doom loop that is currently going on. To me, it only spells collapse. If we pull our money out of the system, the U.S. financial system, we risk stressing a system already under stress. But if done in large numbers, I would be willing to bet it would get Congress's attention as they sit in the middle of this uncomfortable standoff between average Americans and Wall Street banks, while our democracy hangs in the balance. Moving our assets to Canada is one way to help tip the balance of power more in our direction, but it is up to each of us to decide where our allegiances lie. Do we owe our allegiance to our government whose laws protect the wealth of the wealthy while putting the assets of everyone else at risk, or do we owe our allegiance to ourselves and our families to protect everything we have worked our entire lives to save? This is a personal question and I will not attempt to answer that. However, if you do decide to move your assets north, I would encourage you to write the following letter in order to help change the current system